As mentioned before, we're going to be breaking down some of those economic metrics. And yesterday, Statistics South Africa released the unemployment numbers. Now, unfortunately, these are the worst that we've seen since 2008. Although we did see a marginal uptick at 32.6%, that effectively means that 1 in every 3 South Africans finds themselves without a job. These numbers come at a time when our vaccination rollout is less than efficient. We also are grappling with electricity constraints, hence load shedding, and there are some questions that remain around South Africa's ability, or our government's ability, to stabilize our public debt. Well, to make sense of this, although I have painted a very gloomy picture, Chief Economist from Nedbank, Nicky Weimar, joins us live from Johannesburg. Nicky, this is a gloomy picture that I have painted, but am I too pessimistic, or is there light at the end of the tunnel?
There's definitely light at the end of the tunnel, so I'll explain to you why very soon.
Okay, well, I know you've got a lot to cover, so over to you. Please get straight into your presentation and do explain to us where the light is coming from.
Yes, indeed. Okay, so my job today is, as it is usually, and that is to really give you a quick update of South Africa's recent economic performance, and more importantly, some sense of what to expect in the years ahead. So let's get straight at it. Right, the good news, the light at the end of the tunnel, is that the economy is recovering. And the recovery we've seen so far during the second half of last year and the first quarter of this year has in fact been faster, and it's been stronger than anybody anticipated. As lockdown restrictions were eased during the course of last year, we saw that economic activity did rebound, and that helped to slow the rate of decline in GDP from a frightening 17.8% in the second quarter of last year to 6.2% in the third quarter, all the way down to 4.1% in the final quarter of last year. We believe that the economy probably grew at an annualized rate of about 2% quarter on quarter in the first quarter, and that would have slowed your year-on-year contraction in GDP even further to 3.2%. So that's the good news. There is a recovery underway. So far, that recovery has been driven, really, the rebound has been driven really by continued government support. If you look at that little beige line there at the top, you can see that government kind of leaned against the wind. It maintained its spending, and it provided relief to both households and companies. But the big lift, the big lift to the economy, what really brought about the recovery, is that green line where you could see the strong rebound in exports. That really made a big difference, and that provided significant momentum, and a moderate recovery in consumer spending, which is the blue line there. So that's the good news. We have these two elements that recovered, and recovered convincingly, and that helped to bring about a turnaround in our GDP outcomes. The bad news is that, unfortunately, during the complete economic shutdown we experienced under level 5 lockdown, in the second quarter of last year, that really knocked the economy into a very deep, dark, and damp pit. And so, unfortunately, we do face a very steep upward climb just to get back to 2019's levels. The other little bit of bad news is obviously that even as we are recovering, the economy is still not firing off all cylinders. You can see, if you look at that red line, that fixed investment activity remains exceptionally weak and really has shown no convincing signs of recovery. So there's still that drag on the economy. Added to that, the recovery we've seen so far is still very uneven. It's uneven among income groups, with your lower to middle skilled individuals taking the biggest hit and not really experiencing any kind of improvement in their financial conditions. Added to that, it's uneven among industries. Your sort of contact-intensive industries like tourism, like hospitality, they are still operating at a fraction of their capacity. So that is where we were at last count. That's where the economy was at last count. The big question now, of course, is where to from here. So what we're going to do now is I'm going to take you through all the sources of demand in order to determine where the growth is going to come from in the years ahead. So that's what we're going to be doing. But before we go there, we're going to deal with the elephant in the room, which is obviously COVID-19. Now, as you all know, we are currently experiencing a third wave of rising infections. And on Sunday, President Ramaphosa announced that we will be returning, or we have returned already, to an adjusted level 2 lockdown. Now, our view on the threat posed by COVID-19 to the economy and to the recovery is that as long as South Africa can avoid the madness of level 5 and level 4 lockdown, then this wave of COVID-19 and future waves of COVID-19 will dampen the recovery. It will limit our upside. It will slow our rate of recovery, but it won't stop the recovery in its tracks, nor will it reverse the gains we have made so far. And of course, as time goes by and South Africa finally starts to gain some momentum with its vaccine rollout, the impact of COVID-19, as we've seen in the United States, in the UK, and in Europe, will become less and less severe. So that's our view of the potential threat COVID-19 still faces for the economy. If we can avoid level 5 and level 4, we should see that the recovery continues. Within this context now, I'm going to take you through our expectations for the economy. So let me start off by saying we do expect the recovery to continue. But unfortunately, we believe it will remain an uneven recovery. Why, you may ask? Well, for starters, government's finances are just too fragile, they are just too stretched for government to provide any assistance to this economy. As you can see on this graph, the budget deficit is enormous. That was the damage of lockdown, that was the damage of the pandemic. Last year, it was over 10% of GDP. This year, they want to reduce it to about 9% of GDP. On top of the fact that they're dealing with this enormous budget deficit, obviously our debt burden jumped to over 80% of GDP. So government essentially sits with a massive budget deficit and a mountain of debt, right? And the reality is that what you're going to see going forward, we know that last year, the bounce in tax revenue towards the end of the fiscal year will probably result in a slightly smaller budget deficit for the fiscal year that ended in March than they indicated in February's national budget. But the reality is it's still going to be over 10% of GDP. And we're still going to live with budget deficits well in excess of 3% of GDP for several years to come. Added to that, we've recently learned that the demands for funding from state-owned enterprises are more likely to increase than to reduce. And if you add the debt of state-owned enterprises to South Africa's gross government debt, then we sit with a debt burden already last year that hit over 100% of GDP. So this is the precarious situation government finds itself in. And no matter which way you look at this situation, the only route to fiscal sustainability is for government to cut spending. Now, what that means is that government will be a drag on GDP. They will be a drag on growth, not just this year, but many years to come. Another source of weakness is going to be fixed investment. Fixed investment took an enormous hit in 2020, and as you can see from the slide, it's barely recovered. It's shown no real convincing signs of recovery. The problem here is really that dramatic implosion in the red line, which is capital expenditure by state-owned enterprises. And the reality is that state-owned enterprises capital expenditure by SOEs are not going to miraculously recover. It's just not going to happen. Firstly, they are in deep financial trouble. Secondly, they don't have the cash flow. Thirdly, they don't have the balance sheets. And more importantly, they don't have the skills, they don't have the know-how, and they do not have the capacity to drive capital expenditure. So this is a problem because the implosion in state-owned enterprises really, and their fixed investment impacts and have implications for the private sector's ability to expand their operations. The lack of cost-effective and reliable economic infrastructure, whether it is power, road, rail, port infrastructure, really it makes it very, very difficult for private companies to expand their capacity. The reason for that being is that it's physically difficult if you don't have power, and it's also a lot more expensive if you don't have power. Equally, if your road, rail, and port infrastructure is expensive and unreliable, that raises the cost of fixed investment. It raises the hurdle rates for private companies. So SOEs are really the key to unlocking stronger fixed investment for the private sector going forward. So the bottom line here is, if you really want to see a recovery in fixed investment by the private sector, firstly, you have to resolve the energy crisis. This graph shows you electricity production in South Africa. You can look at the red line there. That's Eskom's electricity production, and you can see it is miles below the levels that prevailed prior to the pandemic, and it's been falling for years. We've been saved really by renewable energy, but of course the laws don't allow us to really make the most of that opportunity presented by renewable energy. So unless we solve the electricity crisis, private sector fixed investment cannot recover. Unless we fix SOEs, private sector fixed investment cannot recover. And that's not all. Ultimately, you also have to improve the investment environment. As it is, we are pouring precious resources into a bucket that is leaking at the rate of knots. And government has a lot of work to do here. They have to resolve the corruption within their own ranks. They have to make better policy choices. They have to deal with a mountain of legislation that is actually a deterrent to fixed investment, adds to the hurdle rates. And then added to that, often when they do have good policies, it just never gets implemented. And they have the limited capacity to implement it, even when they do make an effort to implement it. So this is really a big job that government has to restore confidence in this economy and to restore a working state. And so ultimately, if you want to see fixed investment recover, then unfortunately, you have to fix the energy crisis, SOEs, and deal with all the inefficiencies within government. And this is not the endeavor of a year or 2 years or 3 years. This is going to take time. So in our view, government spending and fixed investment is going to be a drag on this economy for some time to come. So that means that essentially we've got two major sources of demand left. And this is exports and consumer spending. So exports and consumer spending will have to do the heavy lifting. That's what it comes down to. Now, luckily for us, exports have performed incredibly well in the second half of last year and into the first quarter of this year. Look at that green line. Look how it pulls away from imports. And we, in fact, recorded a trade surplus of over 100 billion rand in the first quarter of this year alone. And we believe that exports will be the key driver of growth in the years ahead. And we base this on the fact that we're anticipating a very strong economic rebound in the world economy, so we're expecting a strong global rebound. If you look at this slide, you can see, look at the one that is green, you can see that most countries in the world have staged a fairly convincing comeback during the second half of last year and into the first quarter of this year. Granted, only very few countries have fully recouped the losses of strict lockdown. Ironically, China, which brought the world COVID-19, are one of those countries, but many countries, as you can see, are very close to 2019's levels. What, of course, made this possible is, firstly, very effective virus control and virus containment in Asia, with the exception of India, of course, but most Asian countries have managed to contain the virus, which led to a revival in trade in that region and ultimately supported the world economy in the process. And then the other thing that have managed, that has contributed to this strong rebound is, of course, the fact that we have seen the development of effective vaccines, and we have seen a very rapid rollout of those vaccines in most of your major advanced countries. Israel is pretty much there. They are at herd immunity. The United Kingdom is very, very close. You've even got some developing countries up there. Look at Chile. They're over 50% of their adult population. The United States are also very close to 50%. These numbers are up until the 26th of May. I read recently that they have now the US is now over 50% of their adult population that have been vaccinated. Many of your developing countries are quickly catching up with them, including most of your European countries, Germany, Spain, Italy, France, and so forth. So that's all very good news. And what the vaccines have allowed them to do is, of course, to open up their economies, allow more industries to operate at a normal level, but very importantly, it offers the promise of ending the pandemic. So there is greater certainty to the economy opening up this time. So that's been a big confidence booster. Another factor that will support global growth in the years ahead is the fact that we have highly accommodative monetary policy in place at the moment. Really, truly highly accommodative monetary policy. As you can see in your advanced countries, interest rates are still near zero. Not only that, they are still undertaking aggressive quantitative easing. Look what has happened to the balance sheets of the US Federal Reserve, the European Central Bank, and the Bank of Japan. It's just simply lift off into the stratosphere. And that is the situation we're dealing with. It's important to note also that quantitative easing during the COVID crisis took a very different form than that which we saw during the global financial crisis. It's a lot broader. You now have central banks not just pumping liquidity into the banking sector, into the financial markets, but also pumping liquidity straight into companies by buying corporate debt and to households. So it's got a much broader shape to it in this particular crisis. So that's very supportive of growth going forward. And the fact that you've got such easy monetary policy, such loose monetary policy in your advanced countries, of course, creates some space for emerging markets as well. It's made it possible, it will make it possible for emerging markets to keep their interest rates low for longer. And even in countries where inflationary pressures are starting to build and where perhaps they have started to hike rates, the fact that interest rates in advanced countries and your low-risk countries are still anchored near zero just means that they don't have to hike interest rates quite as aggressively than they otherwise might have needed to. So that's all very supportive for growth. Another factor that supports global growth is, of course, that fiscal policy is highly stimulatory at the moment. Right, so what we saw in most advanced countries is that the emergency support that they rolled out during the course of last year to households and companies have been extended to 2021. There are even some countries where that emergency support have been extended to 2022. But added to that, we've seen additional fiscal stimulus being announced, and the focus of that fiscal stimulus have shifted from emergency support to infrastructure investment. And of course, the aim of that infrastructure investment is to accelerate the transition to green energy and to sustainable infrastructure. And nowhere, I promise you, nowhere has fiscal policy been more aggressive than in the United States. They've already got a situation where they've implemented additional emergency support in the form of the American Rescue Plan. That is $1.9 trillion that they've currently pumping into the system. That is equivalent to 9% of 2020's GDP. It's just mind-blowing. And that's not all. They're not going to stop there. They plan to also bring online the American Jobs Plan, which is all about infrastructure, the transition to a green economy, and that's going to be an additional $2 trillion. Then there's the American Families Plan, which aims to address inequality in the United States and especially racial inequality. And that's another $1.8 trillion. So it's just absolutely massive stimulus that they're injecting into the system. So given this, given the combination of the vaccines allowing economies to open up on a more permanent basis, and this very powerful cocktail of monetary and fiscal stimulus, there is no doubt in my mind that we will see a strong and convincing global rebound, especially in this year and next year. And it might even spill over into 2023 and beyond. The IMF is expecting strong growth led by the US and China. the OECD likewise, the World Bank likewise. Just to show you some of the specifics, the IMF is looking for global growth of 6% this year. The OECD, I can tell you, is very close to that. They're looking for growth of 5.8%. You can see the US will lead the momentum, and then in emerging markets, they expect the momentum to come from China predominantly. So with this very strong cocktail, of course, it's very supportive of commodity prices. Both the speed and the nature of the global recovery is supportive of commodities. And that's why we've seen this massive rally in commodity prices, which is very encouraging indeed. Now, of course, it looks quite excessive if you look at it from this perspective, especially at what iron ore has done. So there's a very strong possibility that we might see some correction in the months ahead. But I honestly do believe that the infrastructure investment programs that have been announced by advanced countries will be implemented. They will get off the ground. And that is going to result in higher commodity prices, generally higher commodity prices over the next couple of years. So we have a situation where the world environment is very supportive of our exports. So we do believe you're going to have stronger demand for South Africa's exports, and South Africa is going to earn a higher price for its exports in the years ahead. And it's exports that we believe will be the key driver of growth in the years ahead. Listen, there are risks. One of the key risks is the fact that all of this stimulus might be excessive. And you combine that with the disruptions to supply chains we have seen during a total shutdown, it could result in inflation. And recent statistics the world over are actually confirming that inflation is starting to build up in the system. This is the US's inflation numbers. You can see the inflation in April shot up to 4.2% and 6.1%. So there is this risk that all of the stimulus going into the system is going to result in the economy overheating, too much demand chasing too few goods, supply can't actually keep up, and at the end of the day, that results in inflation. And to be honest with you, we know that recent surveys are indicating that input costs, most companies the world over are experiencing that input costs are rising very rapidly. And in advanced countries, they are also finding that it is possible for them to pass those cost increases onto the consumer. Now, that's the kind of environment in which inflation tends to start to run away. All right, so we have got this fear and this threat of inflation making a nasty return. Not a welcome return, but a nasty return. And at the moment, you have a bit of a dichotomy out there. Investors in the US Federal Reserve are looking at inflation from very different perspectives. As far as investments are concerned, the current stimulus is excessive. It's going to lead to inflation remaining above the Fed's 2% target for an extended period. And ultimately, it's going to force the US Federal Reserve to start tapering bond purchases. The Fed, on the other hand, looks at the situation and say, no, the rise we've seen in inflation so far is all temporary. Right? It's been caused by supply side disruptions caused by the lockdown. Demand always rises faster than supply. At some point, those supply chain issues will be resolved and inflation will start to recede. The other reason they don't believe inflation is permanent is because there's still a lot of slack in the system. And they point to the unemployment rate in the US and they say, well, it's 6.1% at the moment. That's still miles away from the 3.5% that prevailed prior to lockdown. So they believe there is still space, and it isn't time to talk about tapering bond purchases. But the point is, this is a risk. And what would be the implications if the US Fed was eventually forced to face up to the threat of inflation and they were eventually forced to start normalizing their monetary policy? Well, if they started tapering bond purchases and ultimately normalized interest rates, it would look and feel a lot like 2013. For rich countries, it could actually be quite healthy because we know stock markets are looking very, very pricey and very, very frothy at the moment. So it could result in a correction in stock prices. You'd see rising bond yields. You'll probably see some cool off in global house prices, which are also racing very, very strongly in most of your advanced countries, and you'll see a stronger US dollar. The vulnerable parties in advanced countries would be your firms that are highly indebted and your governments that are highly indebted. But I'll be honest with you, they'll survive it. It will be more uncomfortable, but they will manage the process as long as growth continues. Emerging markets are the vulnerable parties. They will feel the heat. They'll see capital outflows, they'll see the currencies weaken, they'll see rising inflation, they'll be forced to hike interest rates more than they would normally have to, and that could result in multiple debt crises. So this is a risk we need to be aware of. We don't believe it's going to undermine our growth prospects right now, but it's a risk we need to be aware of. Right, so that brings us to our final source of growth, which is the consumer. We do believe consumer spending will start to pick up and will accelerate a little bit during the course of this year and next year and help carry the economy to a stronger place. Now, consumer spending's already recovered quite a bit. This graph shows you wholesale sales that is already back to the levels that prevailed in 2019. Retail sales are very close to that. And vehicle sales, new vehicle sales, are in fact above the levels that prevailed in 2019. Now, the problem with the consumer, though, is that the fundamentals that drive spending isn't entirely convincing. Right? As you saw yesterday, the unemployment numbers came out, and that continued to increase. We also saw a dip in employment. We did predict that, so it isn't really that much of a surprise to us. We saw employment dip again, but since the depth of lockdown in the second quarter of last year, we've seen some employment gains, but it's miles away from the levels that prevailed prior to lockdown. Equally, we've seen compensation of employees increase a little bit. All right, but also, again, not spectacularly. And so what does this mean? This means that the recovery we've seen in consumer spending so far has been driven almost exclusively by the fact that because people are working remotely, they've got lower expenses. You've had a very sharp fall in inflation, so that's increased the purchasing power of households, and you've got low interest rates. So low interest rates have reduced the cost of existing debt, freeing up spending for either freeing up income, for either discretionary spending or savings. And up until March, we have seen that consumers have changed. They are measuring their spending and they're building their savings. So much so that South African households became net savers during the course of last year. Now, this is completely unheard of, yet that's exactly what happened. So there's this stash of savings. And if confidence were to improve, they could start to divert this savings into spending. But confidence needs to improve. So listen, we are not very optimistic about the prospects for earnings going forward. We think earnings prospects for households are muted. We believe wages will be under pressure. We believe employment will only recover very slowly. So that's not going to do the trick. That's not going to convince them to divert their savings to spending. That's not going to boost confidence. So really, there's only two factors that can do that. That is low inflation and low interest rates. So in the 2 seconds I've got left, let me try and run you through that. So what are the chances of inflation remaining low and interest rates remaining low? So let's have a quick look at that to wrap up. Well, as far as inflation is concerned, like everywhere else in the world, in South Africa, we've seen inflation rise. Our inflation rose. Consumer inflation went to 4.4% in April. Our producer inflation, similar to the US, jumped to 6%. But you've got to bear in mind that these numbers are heavily distorted by the low base that prevailed prior during the course of last year. In April last year, consumer inflation was 3%. And producer inflation was only 1.2%. So the base is exaggerating everything. However, there's certainly inflationary pressure building up in the system. At the moment, the sources of inflation in South Africa are almost completely external. In other words, it's imported. It's basically the normalization in global oil prices. It's rising global food prices. It is also higher prices on a whole range of intermediate imported goods. So that is causing some inflationary pressure, but we don't believe it's going to run away. And the reason we don't believe it's going to run away is because there are certain counterbalancing forces at play. One of them is, of course, a remarkably strong rand. The rand has surprised us all. It's pulled back to pre-pandemic levels, and it's remained very resilient and very strong. But here's the thing, we can't really rely on a strong rand as a policy to contain inflation. Why is that? Because the factors that determine the value of the rand are themselves highly volatile. In this graph, I show you what that factor is. In our view, the rand is predominantly driven by global investors' risk appetites in general and their risk appetite for emerging market assets in particular. And here I show you emerging market risk appetites against the value of the rand. And you can see there's a very, very close relationship. So the problem with that is risk appetite is highly volatile. Right now it's positive because, rock bottom interest rates in your low risk advanced countries and the expectations of a strong global rebound have really encouraged risk appetites, and it's encouraged investors to go and look for other assets, riskier assets and riskier jurisdictions to get a higher yield. But it can change. That's the problem with risk appetite. It's very, very unpredictable. The other reason we can't count on the rand to do the heavy lifting for us and keep inflation low is very simply that the rand is probably at current values very close to fairly valued. If we were to measure the rand against emerging market risk appetite, so now we take in this graph, we take as our base year 2011, and we ask ourselves, where would the rand have been if it traded from 2011 exactly in line with global risk appetites? Well, it would have been at 13 Rand 10 cents to the US dollar. So it's very close to that as we speak at the moment. If you use inflation differentials purely to determine the valuation for the rand, well, then the rand's slightly overvalued. So the rand doesn't have a lot more upside. It can't do a lot more of the heavy lifting. We believe the rand's going to hold value, but it's not going to strengthen dramatically further. So the good news, though, is even if the rand were to come under renewed pressure, that's not necessarily going to result in inflation, because the one thing we've seen is we've had many rand crises over the last decade. And even despite that, inflation has continued to decline. And the reason for that is that the pass-through from rand weakness into consumer prices have been very weak. And the reason it's been weak is very simple. The biggest factor containing inflation in South Africa is subdued demand. Demand is subdued. So it's very difficult for companies to pass cost increases, no matter what the source of those increases, onto consumers without sacrificing their volumes. So it is weak demand that has contained inflation. In economic speak, what is that? That's a negative output gap. We have a massive negative output gap. Now, the Reserve Bank believes that the negative output gap will narrow as the economy recovers. But they believe we will still have a negative output gap by the time we get to 2023. Okay? The interesting thing about the Reserve Bank, even though they foresee for the next 3 years we will have a negative output gap, in other words, demand will fall short of our potential output, which will dampen inflation. Even though they believe this, they still believe that interest rates need to go up in order to ensure that inflation remains around that sort of 4.5% midpoint of their target range. So this is what they are predicting. Look at that the green line, sorry. And essentially they are saying that interest rates need to go up from starting in this third quarter of this year, which is really just around the corner, and then the repo rate needs to go from its current level of 3.5% to 6.1% by the time we get to 2023. Now listen, that is still below the 6.5% repo that prevailed prior to the lockdown and the pandemic. So it's still quite accommodative. Our view on this, though, is that it will hurt the consumer. Now is not the time to start hiking interest rates. You don't need to, because you've got a massive output gap that's going to take time to close, and that's going to contain inflation. And so ultimately, yes, you need to normalize monetary policy. But for us, that's more next year, once the recovery is entrenched, than this year. And we do think that argument will win sway. And so we think rates will remain unchanged this year, then go up 100 basis points next year, and then remain flat for an extended period of time. And that means interest rates will continue to favor consumer spending. So to wrap it all up, where do we think the growth will come from? It will come from exports. It will come from consumer spending. It will also come from some restocking of inventories by companies. But that upward force will be contained by stagnant consumer spending and weak fixed investment. And what does that give us? That gives us GDP growth of 4.4% this year, 2% next year, and then things start to slow again to 1.4% in 2023, 0.8% in 2024. If we want to raise that long-term growth rate, we have to deal with the obstacles to fixed investment, which is solve the energy crisis, deal with SOEs, and fix the leaky bucket. Okay, thank you. That's my story. And for now, I'm sticking to it.
Nicky, as always, you've got such incredible insights and just a lovely way of being able to, to explain it to the audience in a simple way, but, also really just getting to those points. We literally have a few minutes left, but I'd like to get to a point where I can summarize some of the things that you've mentioned. But I'd like to sneak in a question here. In the end there, you mentioned, the leaking bucket, and you also said that South Africa does need to embark on reforms, as we know. You said it's going to take a long time for us to see some of these implemented reforms come to fruition. But in the medium term, Nicky, and perhaps maybe your view on this, do you believe that the reforms that the government currently has in place are targeted enough or focused enough in order for us to get through some of the fundamental obstacles that we are seeing in the economy?
There's some good ideas there. So the whole notion of us lowering the cost of production, that is a good idea. But I still feel that all of their initiatives, the legislation is so complex. So they'll have an initiative, reduce the cost of production. That will be one policy. So say they're dealing with ports, say they're dealing with road, rail, data infrastructure, data costs. So they'll have that initiative. But on the other hand, they have a whole body of legislation which actually raises the cost of production. You understand what I'm saying? And so their legislation isn't coherent. It doesn't actually, it works against each other. And as a result, the outcome is muted and it doesn't achieve either objective. So we know that this whole body of compliance, its aim is noble. Like BE legislation, the aim is noble. The aim is to correct the injustices of the past and to work towards a more equitable society. But some of that obviously makes business a lot more expensive. Also, it raises compliance cost. So if you do one thing on the one side, you have to rethink the other stuff as well, and they don't do that. And so a lot of their legislation actually works against each other. And the outcome is that it has no real effect. And it's a similar sort of thing with energy. We are now in the process, we haven't actually physically done it yet. We have now changed our legislation to allow private companies, to allow embedded generation, to allow private companies to generate electricity and sell it to the grid, right? But we haven't implemented it yet. So it's almost from the point of announcement, we need about 2 years just to finally change the legislation. Now that helps nobody. That doesn't lift the energy crisis. So these long lags before you actually implement something is negative. The legislation itself is positive. But again, it's always these little bits and pieces. Instead of just saying, we've got an energy crisis, open this market up. But no, we don't want to do that because we're torn as a government. We still want to protect the monopoly of Eskom. And unfortunately, the outcome of that is that you never really truly rapidly improve the underlying environment. So are we slowly crawling in the right direction? Yes, we are. But is it going to change our environment over the medium term? The answer is no. And that's why fixed investment's not going to respond quickly.
Nicky, thank you so much again for bringing us those thoughts. Very much appreciated. Just on that thought on state-owned enterprises, we do have a discussion coming up later on in the session. So I'll be sure to bring in some of the points that you mentioned and pose it to our analyst there, or research analyst, and see if he has any different points to mention. Again, that was Nedbank's chief economist, Nicky Weimar. Just to summarize some of the points that she's mentioned, I think one of the key things that came through was, yes, the global recovery is certainly underway, and of course the rollout of the COVID-19 vaccine being a very key factor there. The infrastructure rollout and the transition to a green economy obviously does leave some opportunities there for the commodity exporting countries such as South Africa. So it does look as though we are actually poised to take advantage of that. But with that said, all the stimulus that we have in the system from either a monetary policy perspective or fiscal policy perspective, there are risks involved. So, we could possibly see inflation overshoot. This isn't something that a lot of economists are in consensus about, but a risk nonetheless.